Yes, yes, my dear. Mm, Sorry, some technical issue. Sound was not there. Yeah, I think it's fine. I think it is fine. Ah, sorry. Uh, right. So this quick revision of Ind AS 103 business combination is crucial for your Ind AS 110 consolidation also. Correct. Most of the points of consolidation are going to be covered as part of this itself. Right. So let's have a quick revision of Ind AS 103, which will be very useful, obviously, throughout your subject. Yeah. Before getting into that, yes, there is some small information. My classes of financial reporting, that is paper 1, which are already completed, recorded lectures are already available. Recorded lectures are already available on an academy platform. Yes, you can subscribe to an academy and yes, you can watch it. It was about 100 classes, totally 300 hours. Effectively it will come to 270 to 80 hours of lecture. We have covered in detail ICA sums almost, and RTP questions, even mock test questions also have been included, and actually more than that it has been included. And I mean, it will be useful for your career as well as for examination, right? And I can give you guarantee on the conceptual clarity without any doubt, and application of that subject with a lot of number of examples, and maximum all probabilities have been provided. So these classes are available on an academy platform, which you can have a look at it, right? And the next one, GFRS classes. GFRS classes, that is paper number 6E, elective paper. This is also recorded lectures are available, and one more batch is going to be commenced in the month of January from 10th. From 10th, we are going to commence a new batch on GFRS. Yes, you can attend live sessions, or if you want to complete it, I mean, right now itself, yes, recorded lectures are available. That also would be sufficient, actually, right? And there is one more program, that is an academy's program, which is CA Iconic program. Yeah, which is introduced for CA final aspirants. Okay, right. In this program, basically, I mean, what are the advantages of this? What are the main things about it? One is doubt solving, right? Whenever you have a question, they will be appointing one mentor. He will guide you throughout your, subscription period. He is the contact person. He will guide you and he will help you in doubt solving, right? If they are not able to, then they'll get back to the teacher. They'll ensure that end of the day you do not have any questions with respect to subject. Next, evaluated test series. Okay, yeah, so they will be conducting tests on every paper. 3 tests will be conducted. Once you are done with 40% of syllabus, then you can go ahead with one test. 80% another test. Once you are through with 100%, then again one more test will be conducted, so you can have a look at it. I mean, you can, once you are done it will be evaluated by the team. They will come out with their suggestions, correct na? After observing your solutions, that will be very much useful to you. Next, if you take a plus course, you do not get a printed material, but if you take this plus course, I mean, printed material will be available to you, right? And these are all correct na? As you know, an academy student in plus courses, you will be able to, raise hand and you can talk to us, correct now? You can ask us orally, it's not only through messages, right? And whatever your you want to share your, you can't share screen, but whatever it is, whatever your question it is there, you can take a pic of it and you can share it, and we can see what you have noted and we can answer you accordingly. Okay, yeah. So this is live mentoring related information. At the same time, evaluated test series, I told you 40%, 80%, 100%, and discussion will be taking place between you and the mentor, right? That will be obviously useful to you, right? So Iconic subscription, because they are providing premium services, so obviously the price also will be bit higher compared to other subscription. CA final I mean, it is available, iconic subscription available for only CA final group 1, CA final group 2, and for combo, right? Combination of group 1 and group 2. Yeah, you are supposed to use the code, that is YESHAS LIVE live. Yeshas live code, you should use it. Then you will get some 10% discount on this subscription. Okay, yeah, this is the information. Hello, let's get into just a second. Today some there is some, suddenly it went off. I'm sorry, I need to can I pause it first? Yeah, Ind AS 103. I'm extremely sorry because suddenly it went off and created some small issue, technical issue. Right. Ind AS 103, business combinations and corporate restructuring. This is your chapter. Yeah, wherein Ind AS 103, which talks about business combination. Yeah. So what is this? This business combination means like it's like which is amalgamations, which are mergers. Everything is going to be part and parcel of this standard. Okay, right. So how do you do accounting with respect to this? Right, as you know, there are a number of differences, and actually it's not comparable. Accounting standard 14 with Ind AS 103. There are so many differences are available, okay, and which you need to be very careful. Number of probabilities, I mean possibilities, and this standard is actually in detail and very depth, right? You need to consider so many things, right, for this standard. Yeah, so which is governed by, obviously, which is governed by Ind AS 103. It is a business combination. So first, what is that we are supposed to prove? Yeah, is it first, when you want to get into this standard, whatever the company has acquired, is it business? First you need to prove, is it business? If it is business, then it is a business acquisition. Listen, if it is a business acquisition, does not mean that you need to purchase the entire other company. Not required. So if you purchase only the business of other business of other company, maybe the other company may be having 4 businesses. I have bought only one business, that is more than sufficient. Then I am supposed to follow Ind AS 103. And in Ind AS 103 business combination, I may get a goodwill. Got it? Right. That also you need to keep in mind. Right. So I told you, it's not that you need to purchase entire company not required. Even only one business of another company, if you acquire, that is also part of my standard. Yeah. So as per, this is governed by Ind AS 103, right? Next, as per Ind AS 103, we will follow acquisition, purchase, right? We'll follow which method? Acquisition method. And actually there is no concept of pooling of interest method. That pooling of interest method is only applicable with respect to CCBC, we call common control business combination. What is that? Common control business combination. Yeah. This common control business combination, this is actually a carve-in. Okay, I mean in IFRS there is no concept of common control business combination. Only in Ind AS they have inserted this concept of pooling of interest method. They are applying it only with respect to common control business combination. That also is part of discussion which will be covered in some time. Okay, we will be following for other than that common control business combination. Okay, in any kind of business acquisition, it is only one method, that is acquisition method, or people can call it as purchase method. Okay, right. Next, what is business combination? Yeah, when you get the control of the business, one or more business, when you get the control of one or more business, correct, it may be a pure merger also, it may be pure merger also, still it will be covered by Ind AS 103. Okay, right. Next, what do you mean by business? Business is an integrated set of activities, okay, and assets, and is capable of being conducted, managed for the purpose of providing returns to investors or owners, anybody. Here, if you observe this carefully, what is the point? Integrated set of activities, and there are some activities are going on. It is not just purchase of assets, right? So when I say it is a business, so there will be a people, there will be assets, there will be certain procedures, obviously, correct? There will be certain procedures they will be following, they will be doing some business, and from the business, correct, they will be making some profits. That profits, that is nothing but returns to the investors or members or participants. So first you need to ensure whether there is a business. So in case of business, when to say a business, there are three elements. One is input, then there is a process, then there should be output. Yeah, input could be what? Input could be human resources, that is employee, and there can be tangible, intangible assets, can be inputs. At the same time, what is a process? Correct. What is a process? As I told you, there should be a standard protocol. Correct. Let us do this business step by step. I mean, how are we doing? There should be some procedures. That's all we can say process. And output. Yeah, there should be output from your business. There must be, correct. What is the output? There must be some profit. There must be some returns. Correct. That may be a dividend. That may be interest. There should be reduction from the cost. If it is there, if all the three elements are there, then I can say it is a business. And what you have acquired is business, then it is a business combination. Then please come to accounting standard Ind AS 103. Okay, right. Suppose say all the three elements does not exist, not exist, but acquirer can produce output from its resources. That is possible. Sometimes what happens, we are acquiring some business, we are acquiring something, it doesn't have all the elements. Okay, right, but doesn't matter what happens, we may be acquiring some part of it, remaining part is with me, our remaining part I can get it done. Okay, I have the, suppose say example, I'm not taking accounts department, I'm not taking the marketing department. The reason, we have already a big marketing department, we have a big team of accounts department or something like that, then that is also sufficient. We can say still it is a business. Next, it's capable of generation of revenue. That is more important. Maybe for the time being, at the minute, they have the capacity, but there is no sales. There are no sales as of now. Still, we will treat it as a business because the sentence is capable of generation. That is, capability is what important. Okay, right. So there should be set of assets and activities which has a goodwill. Is right. Suppose if you say there is some goodwill, we are paying premium money for it, then immediately I can say you are paying some premium, means excess money. I can directly say there is a business, there is goodwill, means there is business. Most likely 99.9% I can say there is a business. Okay, if it is not a business, sir, if you say it is not a business, whatever it is not satisfying the above criteria, then what do I say? You have not acquired business, my dear friend. You have acquired fixed assets or some assets. It may be non-current assets, that is a PPE, or that is intangible asset, is what something you have acquired. Got it? If it does not satisfy business combination definition, then it is going to be treated as a purchase of acquisition of assets. Then you are supposed to follow relevant standards. Which all those? That is, if it is a tangible asset, then it is PPE. Intangible asset, then it is 38. Correct now? If it is investment property, 40, 41. That is, respective standard is supposed to be followed. And here, try to remember, whatever the consideration you have paid, you must have paid a lump sum consideration to get some set of assets. This consideration is supposed to be bifurcated among the assets acquired by you. This consideration should be, what is that I said? It should be allocated among the assets. In which ratios are? In the ratio of fair value, respective fair value ratio में total purchase consideration is supposed to be allocated. That is one small point, right? It should be allocated based on the relative fair values, right? How to get control of acquiry? Yeah, what is that I said? How to get control of acquiry, right? Fine. What is there? Two ways generally. I mean, you said control of business you are supposed to get. But how do I get control? There are two ways. One, you acquire the net assets of the entity. Correct? If you acquire the net assets, that means entire business, I mean, you are paying the money for that. Then it is yours. Or acquire any significant equity interest in the other company. Yeah, that means, I mean, if I purchase more than 50% of the stake, then I will be controlling the other company I will be controlling, because the business that is operating and financing decisions of the other company is going to be governed by me. That means I have a control. That control is not just with respect to few assets, entire company. Now I can say company itself has been acquired by my entity. Then it is obviously a business combination. Yeah. How do you correct now? All right. I said we will acquire the interest, I mean equity interest, or we acquire the net assets. That's what we said. Yeah, for that obviously you are supposed to pay some consideration. Yes, our consideration can be either in cash equivalents, correct? It may be by issuing the debentures, preference shares, or issuing equity shares. It may be a combination of all, correct? We will be doing anything out of it, correct? Now, I mean, you will be paying different type of what is that consideration you may be giving, right? Next thing, before we go to accounting, my dear, okay, first you need to identify who is the acquirer, which is very crucial. Who is the acquirer? What is the date of acquisition? These are all very crucial. Why, sir? See, as per acquisition method, acquirer will be recognizing the net assets, I mean identifiable assets and liabilities of acquiry at fair market value. Okay, so then when business combination is taking place, so you need to identify who is acquirer, who is acquiree. If I say A is acquirer, then A will be recognizing the assets, identifiable assets and liabilities of B in its books at fair market value on the date of business, date of acquisition. That's why, again, next point which I am going to teach, what is date of acquisition? That also you are supposed to ensure. That is also crucial. Why, sir? Why means you have to calculate the fair market value on the date of acquisition, which is correct now. Suppose fair market value will be changing day by day. Suppose today fair value of something, after 1 month fair value may change. Correct. That's why a date is also crucial. That date fair value only supposed to be considered. So who is acquirer? Acquirer is the only acquirer will follow acquisition method, correct na, to identify acquirer, correct? So who is acquirer? Generally who is acquirer means is the one who will transfer the cash or other debentures and etc. to other party, correct? Who will give the consideration is acquirer, right? Acquirer is the one who has the significant, correct na, significantly greater stakeholding. He has it. That is also correct, right? But there is one more exceptional situation which is called reverse acquisition. Yeah, what will happen in case of reverse acquisition? Reverse acquisition may, who is giving the cash or something consideration, no, that may not be acquirer, because, right, you obviously must have studied it. Yeah, suppose there is A party, there is B party, okay, right? What do you say? A, B, they opened a new company called A, B, Okay, A is getting liquidated, B also may be getting liquidated, assume. Okay na, right? Or AB can continue. I mean, it's okay. That is just a structure of the thing. Now AB is the one who will be issuing the shares to A company, issuing the shares to B company. But here the concept is AB is issuer, but AB is not at all is acquirer. Okay, so why, sir? Right, actually AB is a new company which is formed, correct na? In the new company, if I say this company has got 40% stake and this company has got 60% stake, that means the new company is going to be controlled by the shareholders of B company, right? So it is actually a situation where B company has acquired the A company, correct na? By being, right? By being, what do you say, my dear? Right, yeah. A B company acquired it by having 60% stake in the AB company. Agree? By having 60% in the A company. So it is in this situation, even though AB has issued shares to A company and B company, but actually B is the acquirer. If you say B is the acquirer, the minute you say in the consolidation, in preparation of in the preparation of financial statements of AB company, we will take B company's book values and A company's fair market values are supposed to be considered, like that. Okay, right. At the same time, suppose A company is there, B company is there. Okay, right. Now A company is issuing the shares to B company. Okay, good. But what is happening? A company had how many shares? 100 shares. But the fresh shares what are issued to the B company shareholders is equal to, let me say, 200 shares are issued by A company. Now listen, what are the new share capital in the company A? Totally 300. But out of 300, 200 shares are governed by B company. That means who bought whom? It is not A bought B, it is actually B bought A. Hope you followed. Because in the new company who has really control, that person is what? Acquirer. That is what crucial, which you need to keep it in mind. Fine, right? So to determine all these things, fine, you have to consider some facts. What all that? Who has largest portion of voting rights? In this case, in my example just now, 100, 200, 300 example, who has largest portion? B has large, because out of 300, 200, that means 2 by 3, that is equal to 66.67% voting power in A is held by B shareholders. That means B acquired A, but not A acquired B, even though A issued shares to B. Correct na? Generally, the above sentences are correct, but in reality, when you are solving the sum also, you should be very careful. Is it a normal kind of acquisition or is it a reverse acquisition? That you need to keep in mind. Next, the ability to elect, appoint, remove majority of the directors. This is also crucial. Yeah, recently I have seen one company wherein we have only 49% stake. Okay, but we have only 49% stake with respect to percentage 49 only. But there is managing board. A board has 5 people. Out of 5 people, 3 people are supposed to be elected by me. Correct now? Why means? Yeah, because there is an agreement between the stakeholders. Because one is me, I have 49%, other company has 51%. Even though they have 51%, because of the skill set, because of the some other elements are there, which obviously I can't share it right now. Okay, right. We are appointing, this is agreed, which is mentioned very clearly. So 3 people out of 5 people are going to be, correct na, our directors. That means every board of directors decision, is going to be done by the company which has 49% only. Then I have control. You got my point? I have control. Control is important. It's not the stake always. Okay, that is the important thing. Do I have ability to appoint board or something? Yes, then fine, it is supposed to be. Next, management dominates the combined entity. Correct? Who is dominating? Yeah, correct. Now management, whose management is dominating? My management is dominating because I have 3 people out of 5 people, then obviously yes. Got it? Done. Now, what is reverse acquisition? Even though I have explained, let's read few lines of it, then that will give you a better idea. Right. In some circumstances, issuer of the shares, correct? Issuer of the shares will become acquiree. Correct. Issued to whom is going to become acquirer. Right. That is for the accounting purpose. We say, correct. Legally A issued B, A issued shares to B. Now, what do you say? A is going to be legal acquirer. A is going to be legal acquirer. Yes, continue from the point of view of law, A is the legal acquirer. Agreed. But with respect to B, what is B, sir? B, what do you say? This guy is called accounting acquirer. He's accounting acquirer. Correct. So that's why when A is preparing financial statements, we will consider A's fair market value of assets and B's book values of assets. That is what the matter. Yeah, a small entity has 1000 shares. Okay, but as part of agreement, it issued 1500 shares to others. Right, so it's going to become how much? Totally 2500 shares. But 2500 shares may you gave it to me 1500. 1500 divided by 2500, automatically other company is getting the control. That is reverse acquisition, obviously straight away. Correct. Next, what is the acquisition date? I told you this is also crucial. It's simple. Which date you really got the control? Which date onwards I can start taking the decisions? That is what crucial to us. Okay, right. Date on which control is obtained. What did I say? Date on which control is obtained. Generally, date of transfer of legal consideration. Okay, right. Generally. But see, end of the day, you are supposed to look at from which day I can really start using my power. That day is what the date of acquisition. Okay, it's not like agreement date. It is not like some other date. Okay, keep that in mind. Yeah, some cases it can be later, it can be earlier than this date. Yeah, it's not the legal consideration. It can be any date. Okay, but just generally, right? So why are you bothered about? Because the fair market value of acquiree asset, fair market value of acquiree assets are measured on the date of acquisition. Fair market value of acquiree assets are measured on the date of acquisition. That's why we need to focus on the acquisition date as well. Okay, my dear. Right. So now let's go to the next step. Yeah, sir, we decided there is business combination. Whatever we have acquired is satisfying business definition. Business definition, integrated set of activities and assets. Correct? Na? Yes, to get some output. As we said, there are 3 elements. There is input, there is process and output. Correct? So when these 3 things are there, then I say it is a business. If it is a business, Ind AS 103 purchase method or acquisition method is going to be followed. Right? As per purchase method, right, what do? We'll recognize all identifiable, remember the word identifiable specifically. Correct? Students do write all assets. No, not assets. All assets not correct. Identifiable. It may be recognized by the acquiree, may not be recognized by the acquiree. It should be recognized by us. It may be recognized by the acquiree or may not be recognized by acquiree. It should be recognized by us. Got my point? Yeah. Measurement of goodwill or gain from bargain purchase. Right. So you will be taking, fair market value of all identifiable. Yeah. Simple example. Yeah. See, my acquiree has some intangible asset. Okay. They have brand, example. Because, right, the brand acquiree must have not recognized it. Why? Ind AS does not permit. Why Ind AS does not permit, my dear? It is a self-generated brand, prohibited to be recognized as an asset. Correct. Yeah, acquiree did not recognize it. But when I am acquiring the other company, I am paying for it. Correct. Now, obviously, right? So I should be recognizing even that brand in my acquirer books. कहाँ देखना? Even in my brand, the acquirer books. Yeah, acquirer books में we will be recognizing it. Recognizing at which value? At fair market value we will be recognizing it. It is not at book value, because book value is equal to 0. Okay, it will be recognized at fair value. There are some concepts as per accounting standard 14, there are some concepts are there, but those concepts not applicable here. Okay, right. So now next, what we understood, who is acquirer, who is acquiree concept we have learned. Next we have understood what is that acquisition date. Correct na? What is acquisition date also we have understood. Done. Let's focus now on next small point. How do you calculate goodwill or capital reserve? Yeah, this is what crucial. In every sum you are supposed to calculate this goodwill or capital reserve. Yeah, so fair value of, correct na? First, fair value of the purchase consideration. Remember my dear, you are not supposed to write just purchase consideration. You have to record the fair market value of what you give and fair market value of what you get. Everything should be at fair value. Okay, fair value of the purchase consideration. Yes, done. Next, fair value of the shares already acquired. It may be step by step acquisition. Correct. Maybe I have already 40% stake. Yeah, when did you buy? Sir, I bought 1 year ago. Okay, na? I bought 1 year ago. I already bought 40%. That time I paid 1000 rupees, sir. Okay, excellent. But today I have got, today is equal to which day, sir? Today 15th December 2021, I got 20%. So since I have got 20%, I now my total shareholding has become 60%. Now my total shareholding has become 60%. Now I have got control. Yeah, so I will say date of acquisition is equal to 15th December. Correct. Now for 20% के लिए you must be paying now only 400 rupees you are paying. How much are you paying? 400. Correct na? So fair market value of PC you must have written 400. But is it the total consideration? Obviously not. Correct na? Right. Isn't it whatever you have paid earlier also? Correct. But here, when did you pay this? 1 year ago. That is the information I gave. You are supposed to take fair market value of already acquired. Maybe right, that day you paid 1000. Today fair market value is equal to 1200. Then you are supposed to take 1200 only in my calculation of goodwill or capital reserve. That is bargain purchase, gain from bargain purchase. Okay, right. So sir, it was recorded 1000 rupees na. 1200 कैसा record करेंगे sir? Right. Difference, there is a difference of 200 rupees. 200 rupees to directly go to profit and loss. Okay, right. That is which profit and loss, sir? Obviously consolidated profit and loss ko you are supposed to transfer it. Okay, you should transfer it to consolidated profit and loss. Fine. Right. Next. That's all. Not that's all. Totally I have how much? Only 60%. What about the 40%? If 40% is held by others, in accounting standards we call them as minority interest, but now we call with a different name, that is non-controlling interest. Correct? NCI, non-controlling interest we call, yes, amount of NCI. Right? The amount of NCI which will be given below, you have two methods to account. Right, it is as per the accounting policy. Yes, there are two methods are available as an accounting policy choice. What is that I said? As an accounting policy choice, you can pick whichever the method you want, either first method or second method. Yeah, first method will be fair market value, you can take it. NCI 40% means, correct, 40% means maybe let's say for some 40,000 shares example. Today market value is equal to how much? Yes, there will be some number. Correct na? Some 100 rupees, something like that. Market value of the share le lo, multiply karo, number you put it here. Or you can go by, what is that? You can go by proportionate to net assets, proportionate to fair market value of net assets. This is the fair market value of net assets. Correct. There will be some, say, let example, some 2000 rupees has come. 2000 into 40% is held by these guys. Our number you can keep it here. There are two methods which is as part of accounting policy choice. Accounting policy, pick whichever the method you want. Got it? Yeah. Fair market value of identifiable, right? Next, this is the total. Yeah, but try to understand, this is nothing but 100% of the subsidiary company, correct? Now, total value of the subsidiary company. What is that you paid? Either paid by me, it is held by NCI, correct? Now, then total net assets of the company, total net asset, identifiable net assets, fair market value of identifiable net assets of the company should be taken here. Okay, our difference is what? Either goodwill or capital reserve. That is what gain from bargain purchase. That is what we'll tell. Right. Try to think once again and try to understand different fashion. See, when I say I am controlling the company, correct? Na? What do I say? When I say I am controlling the company, it's not that I am controlling the company for 60%. Getting my point? Right. Try to understand, my dear. When my board of directors has taken 10 decisions, does it mean that just because I have 60% share capital, only 6 will be approved by me and the balance 4 will be approved by NCI? It's not like that. Every decision taken by the board is going to be correct. Is going to take place. Correct. Everything will be taking place only because of my approval. Agree? Even though you have 60%, that means every operation of the company is going to be controlled by me, right? That is the reason you are supposed to recognize 100% value of the goodwill. 100% value of the goodwill should be taken. It's not only your portion. Okay, 60% of assets and 60% of what you have given. No, that is not the right way. That is not the correct way to calculate, right, goodwill or capital reserve number. Okay, right. Fair market value of consideration given. One by one we'll start explaining. Then we'll go to business combination at one, full stretch. Yeah, whatever you have given. Yeah, you may be giving cash, then directly what you gave. Cash, bank, you will take it directly. Sometimes you may be giving our own equity, our company equity shares, you may be giving it. Correct? Na? Yes. So when you give our own equity shares, what will happen, my dear? There will be fair value for your shares given. Yes, a fair market value only should be taken. That is one. Okay, right. Yeah, something. Suppose, sir, I have not given. What is that? Shares I have given. Some assets also are given. Yes, fair market value on the date. Which date you gave? Our date fair market value is supposed to be considered for this purpose. Okay, excellent. Right. Yeah. And next point is what, sir? Contingent consideration. That is also supposed to be considered. Sir, what is contingent consideration? We promised them. When you satisfy, sir, you receive. You told that your company is making good profit, that this and all, you are paying less. Agreed. But we will tell, see, if really your company makes good amount of profits in the next year or next year, some time thing will keep it. If it really satisfies, then I will give you additionally some number of shares. Correct. I will tell, so additionally some number of shares I will give, or additionally some cash I will give it to you. Something like that I will very clearly mention it. Getting my point? Right. So that is contingent. Correct. When do I need to pay? If that condition is satisfied. If condition is not satisfied, then I am not supposed to pay anybody. Correct. But contingent consideration fair value also supposed to be considered. When I say fair value, right, whoever is measuring the fair value will be considering what all the possibilities, correct, probabilities of success, right? If it is what do you say, if the valuer feels that it will be successful, then fair value will be correct. Probabilities are high, then automatically fair value he'll keep it big number. Correct? So when I say fair market value, it is already after considering the probabilities of success. Okay, that is contingent consideration. Yes, anything, options or shares, etc., and the date of acquisition, whatever is the fair value of it, that is supposed to be considered. Okay, right. Let's look at some more sentences which are very crucial points. Yeah, any gain or loss on transfer of assets will be transferred to P&L. Means what? Suppose example, yeah, I am giving assets. Yeah, I'm giving some PPE to somebody. Yeah, I have 100 rupees is the book value. But today I am transferring it to that other company shareholders. But today fair market value is equal to 150. Correct, na? Right. That means there is a gap of 50. Each gap of 50 we are referring, that should be transferred to profit and loss. Next, there can be a deferred consideration. What is deferred consideration? Deferred and contingent both are not same. Deferred means guaranteed, but it is going to be given at later point of time. Time gap is there, but correct, na? It is guaranteed you are going to pay. Yeah. In case of deferred consideration also, yeah, what do? You are supposed to measure it at fair market value only. You are supposed to measure it at fair market value only. Correct, na? Means what? You just bring it to present value of it. Suppose if I say what do I say? Yeah, I will pay you some 10 lakh rupees after 2 years. I will pay. It's not depending upon the contingency, nothing, no contingency is there. Okay, that I will pay you to 10 lakh rupees after 2 years. Right, just a second. Yeah, so you bring that number. What is that? 10 lakh rupees. Bring it to today value. That is nothing but called present value. Okay, that is nothing but called present value. Our present value will be taken for the calculation of goodwill or capital reserve. That's it. Next, yes, we'll be discounting by using appropriate rate. It's basically a loan kind, my dear. Okay, it's basically a loan kind. I mean, normal, incremental borrowing rate, what is there? Our rate, you can apply it and you can discount for. Second, recognize the fair market value of contingent consideration as liability. No, this sentence, I don't say it's a liability. Liability or equity, both you can write it actually. Okay, liability or equity. Are you getting my point? Yeah, what is that? Liability or equity? See, whether it is a liability, whether it is an equity, what actually you are supposed to do, you should refer Ind AS 32. You are supposed to refer to Ind AS 32. You are supposed to refer. As per Ind AS 32, if it satisfies a financial liability definition, then it is a liability. Otherwise, suppose if we may say, I will give you equity shares if it you satisfy the contingencies, then it is a it is equity, it is not a liability. Correct, na? Right. If you remember Ind AS 32, that is Ind AS 32, Ind AS 109, that is financial instrument chapter. If the terms and conditions are saying for fixed amount, a fixed number of shares are going to be given for fixed amount of consideration. What is that I said? Fixed amount, fixed number of shares are going to be given for fixed number of fixed amount, fixed number. Both are fixed, then it is going to be equity. Okay, right. In any other combination, that means fixed variable, variable, fixed variable, variable, then it is going to be financial liability. That concept, basic knowledge of Ind AS 32 is applicable. Why are we bothered about it? Because next on the balance sheet date, subsequent measurement date, I will tell, if it is a financial liability, if contingent consideration is a financial liability, I will tell you have to remeasure it. And if there is any increase, decrease, it should go to P&L. Right. And if the contingent consideration is an equity, if the contingent consideration is equity, if it is going to be classified as equity, no further adjustments. I mean, no remeasurement will take place. What will not take place? Remeasurement will not take place if it is equity. That's why you should be careful in measuring contingent consideration. You should be careful in measuring contingent consideration. Okay, done. Okay, where the control is achieved in stages. I told you fair market value of earlier acquired equity should be considered irrespective of the method followed for accounting earlier. It doesn't matter. Fair market value you consider, and the difference should be transferred to P&L, which I told you some time before. Okay, gain or loss on fair market value of earlier acquired equity should be transferred to P&L, which I told you. Any accumulated OCI, right? If there is any accumulated OCI with respect to already acquired equity, right, that should be treated as if the investment has been sold in the market. Okay, yeah, as if the investment has been sold in the market. Yes, it is like that. Suppose what do I say? Suppose you have revaluation reserve, OCI, correct? Now what should I do? Generally, what do you do? Revaluation reserve. If the respective asset has been sold, revaluation reserve will be transferred to retained earnings. It will be transferred to retained earnings. Are you getting my point? That's all. Like FCTR, that will be transferred to P&L. Revaluation will be transferred to not general. It's okay. General reserve, retained earnings doesn't matter. So assume that respective asset has been sold off and go to respective standard. Our standard may what is what explained, the same thing you are supposed to follow now. Okay, next, direct costs incurred to get controls. Like what is that? Direct costs. You have spent something for this business acquisition, correct? When we are acquiring another company, there will be brokerage, there will be legal costs, there will be so many expenditure, correct? Brokerage only will be huge actually, right? So those costs, what are we supposed to do? Correct? Can we add it to goodwill? No, there is no such concept. Entire brokerage, legal costs, etc. should be transferred to profit and loss. Why, sir? Why, sir, means simple logic. See, already the, suppose example, I have taken the land from the acquiring company. Land value already I have taken it at fair market value. Got it? Suppose if you have paid again registration cost. Yeah, correct. Registration cost you have paid, but does the registration cost is increasing my fair value? It's not, because I already recorded the asset at fair market value. These costs are supposed to be charged to P&L. Remember, if I purchase from another company only land bought for 1 crore, 6 lakh registration cost, that time 6 lakh will be capitalized. But as part of business combination, you acquire the entire company. So acquiree has land. Our land is in the name of the old company. Now it has to be transferred to my company because I got the control over that. Agree? I have got the control over it. Now this registration cost will not add any value to the already recognized fair market value. There is a reason we say all the registration cost, brokerage, any processing cost, professional cost, all that should be charged to P&L. In Ind AS, it is not allowed to. In Ind AS, it is not allowed to be capitalized. Okay, remember that. Next, suppose if you have issued any debt, sir, I am issuing debenture, sir. Yeah, debenture issue expenses I have incurred, sir. Perfect. This is dealt by Ind AS 109. Yeah, go to Ind AS 109 and follow whatever the standard says. Okay, what are you supposed to do if it is a debenture issue expenses? What do you do? Think of. And if you issue equity shares also, okay, if you have issued debentures or if you have issued equity shares, as per Ind AS 109, respective costs are supposed to be reduced from debenture amount. If it is the debenture is a financial liability, issuance cost should be reduced from the debenture amount. What about equity shares, sir? Yes, if it is equity issue expenses, if it is equity issue expenses, That should be reduced from, correct? Now that should be reduced from, it should be reduced from where, sir? Yeah, it should be reduced from, it should be debited to the equity. That is what the matter. It should be debited to the equity. Okay, that's it. That is fine. That's why we said you follow Ind AS 109. Next, sometimes control is obtained without transfer of consideration. Yeah, it is very much possible. How is it possible, sir? Yeah, say there are some 1,000 shares are there. I mean, there are 1,000 shares in the company, in one company. Out of that, I have 40% stake only. Okay, what has happened out of this 1,000 shares? I mean, subsequently, what happened? E company has bought back 300 shares, right? E 300 shares are held by others, not by me. It is held by others. They have bought back. Now it has become how many shares? 700. Now out of 700, I have got 400, which is, I mean, 40% means 400 only in earlier. Now, have I paid any consideration? Nothing. But I have got control now. Correct now. Which day these 300 shares are bought back? That day is, correctly speaking, date of acquisition. I am supposed to consolidate the financial statements of other company with my financial statements. Got it? Right. So now here what do you say? What is the PC given? 0. Because I have not given, actually speaking. Correct na? Right. True. But do you have already stake? Yes. That's why you have to write fair market value of the already existing stake. That number will automatically come here. Correct na? Plus NCI also will come here. Minus fair market value of net identifiable assets. That number also is going to come. Then you will determine the goodwill or capital reserve. Hope you followed. So many concepts are there. It is not so straight, simple, plus 3 steps, 4 steps. No, there are so many intricacies. Actually, when you solve, when you actually solve very good sums, then you get overall idea. Correctly, that is the beauty of it. Right? Non-controlling interest. That is minority interest. But we don't use the word minority in Ind AS. We use non-controlling interest. Yeah. Measure, you should measure it on the date of acquisition. As I already told you, there are 2 ways. That is accounting policy choice. It is one-time option. Correct na? One time. Initially only you are supposed to measure it. You have an option. Subsequently, that is on every balance sheet date, you don't have any, we don't have any methods, like 2 options are not there, only one method is there. Proportionate profit is supposed to be allocated to NCI. That's it. So at the time of acquisition, that is on the date of acquisition, you have a choice. But our choice is accounting policy choice, which you are supposed to write. Whatever your company has chosen, our choice only you are supposed to follow. That's it. Now, fair market value of minority shareholding. Fair market value of minority shareholding. Okay, 1. Next is proportionate share of net fair value of. This is also correct. Now, fair market value can go, or proportionate of what, my dear? Net fair value. Correct. Now, fair value of the identifiable assets. Proportionate, percentage. We can do it. Right. There is one more small concept which generally students won't bother, and this is not has been asked in the examination. Okay, it's not never have been asked. It can be asked. That I don't know when, but yes, it is possible. It is very much possible. Okay, right. This is called other components of NCI. What is it called? Other components of NCI. Yeah. What is other components of NCI? Right. Includes other equity, part of convertible bonds, options, ESOPs, as per Ind AS 102. I will explain it to you. Right. Suppose, my dear, ESOPs are there. ESOPs are held by whom? It is held by employees. Correct na? There will be ESOP reserve. Agree or not? Share based payment reserve we call SBP reserve. Other ESOP, whatever the name you call, how does it matter? Correct na? ESOP reserve, we name it. Yeah. E number, is it attributable to employees? Yes. Is it attributable to existing shareholders? No, actually. Not shareholders, it is related to. Tomorrow, if the shares have been issued, assume these guys have satisfied their job. Okay, they satisfied the conditions. that is vesting conditions, I mean, and now they are exercising the shares. And aren't these guys who are exercising the shares are going to be NCI, because they are not the members, I mean they are not the major shareholders, right? So such a kind of reserves are going to be other components of NCI. Okay, now generally NCI is what? Suppose you have 1000 shares of equity, share capital is there, correct? Out of that, held by me is equal to 60, 40% is held by NCI, 40% is held by NCI. Understood? Correct. But इదే company has preference share capital, इదే company preference share capital which is classified as equity, this is other components, of equity. Yeah, assume, right, to the extent which is not held by my company, that is parent company is not holding this, then obviously this is held by other company, is part and parcel of other components of NCI. Okay, right. Next, suppose you have got gain from bargain purchase. See, if it is a goodwill, then there is no discussion. Recognize goodwill, I will tell, that's it. Debit goodwill, and in the consolidated financial statement, present the goodwill. Okay, done, over. But if there is a bargain purchase, what is gain from bargain purchase or capital reserve? What do you mean by that? I mean, fair market value, say if I say fair market value of this is equal to 100, someone sold for fair market value is equal to 100, someone sold for 80. Just you understand, how is it possible? When the market value is equal to 100, why will somebody sell for, correct? Now, fair market value means what? In the open market, it is getting exchanged at 100. But why someone will sell it to me at 80? Correct. Now, what is the logic in it? Actually speaking, nobody will sell like that. Correct. Now, actually speaking, nobody will sell like that. Right? Strictly speaking, nobody will sell. But he sold. Means, I mean, you got bargain purchase, means your first basic thing, standard itself is asking, it's not told by Ravi Kanth. First, to go back and check everything. Fair market value, have you computed correctly? Means what? Fair market value of assets and liabilities taken over, fair market value of consideration given, fair market value of existing consideration, or if you are following fair market value of NCI, that one also, entire calculation of gain from bargain purchase has to be rechecked again. Getting my point? Yeah, that is what you are supposed to do it. Right. Just a sec. Yeah, that has to be rechecked once again. Right. Now, why means it is generally not possible. If you say there is an evidence, sir, really they sold it at a cheaper rate, maybe distress sale, something like that. There must be some evidence for your transaction. If you can prove it, then standard says routed through OCI. Means under OCI, we should show that this is the gain from bargain purchase, and in the reserves and surplus, we will be showing it under capital reserve. That is how it happens. Got it? Right. Otherwise, suppose that there is no evidence, sir. If you say there is no evidence, then it will be directly going to reserves and surplus. We do not route it through capital OCI. That's all. OCI, we don't present it. That is what you are asking. Is there any evidence of such gain? First question. Is there any evidence of such gain? Got it? Is there any evidence of such gain? If you say yes, there is an evidence, then route it through OCI and recognize the capital reserve in the reserves and surplus. Yeah. If you say what is that? If you say, right, no, there is no evidence of that, means we are not understanding why such situation taken place. You getting my point? We are not able to understand why such situation took place. Under that circumstance, directly recognize in the capital reserve, do not route it through OCI. This is one of the points, important. Next, as per IFRS 3, yeah, this is a carve out. What do I say? Carve out. Yeah, the concept of what do you say, OCI, capital reserve, actually does not exist. Okay, right? There is no such concept. Then what is there, sir? As per IFRS 3, a bargain purchase, gain from bargain purchase will be transferred to P&L. That's it. Directly transferred to P&L, not to OCI, not to capital reserve. Remember, this is the carve out. Gain of bargain purchase is recognized in the P&L as income in the P&L statement, not as a capital reserve. And there is no concept of OCI routing, that is also not there. No capital reserve, no OCI concept is there in IFRS. Okay, this is the carve out. Next, net identifiable assets. Yes, net identifiable assets. Listen carefully. Recognize the assets and liabilities. Yeah, recognize the assets and liabilities whether exist in the acquirer's balance sheet or not. Recognize the assets and liabilities whether exist in the acquirer's balance sheet or not. Correct. I told you already. Maybe acquiree, not acquirer. Sorry, acquiree. Yeah. Whether exist in acquirees. This is acquirees. Acquirees balance sheet doesn't matter. I told you example of brand, which is not recognized by acquiree because it is self-generated brand. Correct. But we acquired, we are getting that, we are becoming the owner of it. It's as part of business combination, you should take it. Right? Even if it is not recognized by the acquiree company. Yeah, in the same fashion, my dear, suppose there is a research expense. What is there? Research. Yeah, research expense, as you know, as per Ind AS 38, research expenses, any cost, whatever you spent for research, is not going to be capitalized. Yeah, what did I say? It's not going to be capitalized. Correct? It's not going to be recognized as an asset. Intangible asset में recognize नहीं करेंगे. Even though it is not recognized by the other company, but when you are acquiring, right, it is permitted, you can recognize it at its fair value. Okay, the simple reason, I am paying some money for the research work means that itself is a evidence that there will be future economic benefits for it. Correct, na? See, when I am paying some 100 crore rupees for some research work, do you think I am fool, correct, na, to pay just like that? Obviously. Haven't I done my job already? Yes. This is discussed once again under Ind AS 38. You can have a look at Ind AS 38, quick revision as well. Okay, right. So that's why whether it is recognized by the other acquiree company or not, just does not matter. You recognize it if it is identifiable. What do you mean by identifiable? Identifiable means separable. Separable from goodwill of the company. Separable in the sense, separately I should be able to sell it. I should be able to rent it. Correct. Now, separately I should be able to do whatever I want, exchange it. Correct. Sell it, rent it, use it, exchange it, anything I can do it. Separate from the business. Then it is a sub-identifiable asset. Again, we had a lot of discussion on this identifiability word with respect, in Ind AS 38. Okay, right. Classify and designate as per the applicable Ind AS. Correct. If it is an intangible, classify as intangible. If it is an investment property, classify as investment property. That's it. Adjust the consideration for, what is that? Settlement of pre-existing relation. This is one point. Suppose example, pre-existing relation. Pre-existing relation will be actually, pre-existing relation, two kinds of things will be there. One is contractual, one is non-contractual. Okay, contractual in the sense like a debtor, creditor. Yeah, we were supposed to pay E number, correct? I am supposed to pay some number, 2000 rupees I am supposed to pay to other company. Now you are closing it. That is next. Non-contractual in the sense there are some cases. Yeah, earlier before acquisition, acquiree filed like a case against me. Now after acquisition, what do I say? Please, I am controlling, automatically a case will be withdrawn. Now the question, you are supposed to be clear, correct? Now see, suppose example, 1000 rupees is the consideration I am giving, purchase consideration, correct? Now if you say some 20 rupees or let's say 40 rupees has been paid to close the old case, when you say 40 rupees, then what am I supposed to do? 1000 minus 40, 960 only will be treated as purchase consideration. Based on 960 only, you are supposed to calculate goodwill or capital reserve. That's it. You're supposed to calculate goodwill or capital reserve. Understood? Total amount is paid 1000, but out of that, to settle the old relation, old problems. Which what is old problem? Old legal cases are there. To clear the old legal cases, 1000, if you say 1000 में 40 rupees has been paid to clear old cases, that means that our 40 rupees is not for the purchase of the other business. That's why you are not supposed to consider it. Okay, na? You should take only how much? 960 rupees. Okay, na? You should take only 960 rupees. 960 rupees only you should take it. Hope you understood. Perfect. Next, specific guidance. Yes, sorry. Next, one more thing is there. Any remuneration to employees for the future service. Yeah, this is also one of the crucial point. Okay, yeah. Suppose there is a Mr. MD. Okay. Suppose as part of business combination for Mr. Business, this guy, if I am giving 1000 shares, I am giving to MD also as part of BC. Then yes, 1000 shares ka fair market value is a part of purchase consideration. Suppose if you tell something like that, Arey Mr. MD, you have to continue work with me, with my company for 2 years, because you are going to continue for 2 years. That's why I am going to give you 1000 shares in the future. If you put a condition, right, what is it? Try to just think of it. Just think of it, what it is you feel. Isn't it like a share-based payment? Correct, na? You told him you have to work for 2 years. Equity settled share-based payment, you are giving it to this. Next, so ye 1000 shares ka fair market value is not because of business is purchased you are giving. It is because Mr. MD is going to work with you for next 2 years. Correct, na? It is a consideration for his future services. That does not include E number, is not part and parcel of purchase consideration. Hope you got it. Done. Next, reimbursement of acquisition related cost. Obviously no, acquisition related cost means, okay, they have incurred some brokerage, we are repaying brokerage. Array, when we spend brokerage, brokerage also we are charging it to P&L. Yaar. When other spend means I will leave it. Right? Ind AS 103 will allow it. Obviously Ind AS 103 will not allow. That should be charged to P&L, whether it is incurred by you and reimbursed by me, or it is incurred by me, that will go to P&L. Hope you have followed it. Right. Next, contingent. Right. Contingent consideration. Actually, some guidance is there. Contingent liability or contingent consideration, I can add one word here. Yeah. Okay. Right. Even though there is no probable future economic benefit outflow. Yes. Oh, sorry. This is not contingent consideration. I am right. Yeah. What is written is only correct. What is that you are supposed to do with respect to contingent liability? Point is what? Contingent liability. Contingent liability. क्या है सर इसका? Very simple यार. Right. Contingent liability, generally what is the contingent liability का standard? Ind AS 37. Provisions, contingent liability and contingent assets. Correct? Done. Now listen carefully. Contingent liabilities, do you recognize it? No, sir. Contingent liability will disclose in the notes. Perfect. But if my acquiree has contingent liability, me, acquirer, should recognize the contingent liabilities at its fair value. I have to recognize it. When there is a present obligation arising from past event, sufficient. Getting my point? Even though the probable future economic benefits, correct? Now see, if you remember, Ind AS 37 says a provision is a liability. Correct. Now, provision should be recognized. When do you recognize? Only when you satisfy three conditions. Provision should be recognized only when you satisfy three conditions. One, present obligation arising from the past events. Two, probable future economic benefits outflow. Three, what is three? It can be measured reliably, right? Yeah. Our rule is applicable to Ind AS 37. Ind AS 103 overrides that rule. Okay, right. What it says, do even, right, first condition sufficient, present obligation is there, yes, arising from past event, done sir. Even though outflow is not probable, we will measure it at fair value on the date of acquisition and will follow that. So read it, recognize it as a liability at its fair value on the date of acquisition. It is Ind AS 37 is not applicable for this item. I told you Ind AS 103 overrides 37. That's one. Next, income taxes, sir. Income taxes, there are some points, sir. Which point? Yeah. See, this is income tax means nothing but Ind AS 12. In Ind AS 12 also you must have studied. Sir, deferred tax asset. Correct. Now, deferred tax not asset. Deferred tax liability on goodwill. Actually, goodwill, if you basically follow the rules and regulations of Ind AS 12, correct now. If you remember, what is the rule? Tax base and carrying amount. Carrying amount is goodwill has value. Correct now. Tax base is equal to what is deductible in the future? 0. Government department does not allow. Right. There is a temporary difference. Correct now. You should recognize deferred tax liability on this item. You should recognize deferred tax liability. Right. Right. I mean, sorry. Right. You are supposed to, what is that I said? I didn't get you. I didn't understand sorry. Deferred tax liability comes up actually because it is going to be taxable temporary difference. Because carrying amount of asset is more, tax base is 0. That's why it leads to taxable temporary difference. Correct? Right. But as per Ind AS 12 itself, it says, what did it says? Recognizing deferred tax liability on goodwill is prohibited. That's why you are not supposed to create, right? But what about other assets, sir? Yes. Yeah, some student asked one point. Listen, it may take 1 or 2 minutes, but which is crucial. Mostly, many students may not be having the idea in this regard. Okay, I say this is acquiry balance sheet. If I take it like this, okay, right. Acquiry balance sheet may, let me say this is PPE. PP is equal to 1000, that is their book value. Yeah, actually, listen carefully, right? There will be a tax base. Yeah, the tax base for the company means how much is deductible. Maybe let us say 800. Yeah, deductible in the future is equal to 800, but PP is equal to 1000. That means there is a taxable temporary difference of 200. 30% is the tax, that means 60 rupees. There will be DTL of 60 rupees will come. Got it? Done. Now we are acquiring. Who are we? We are acquirer's balance sheet. I want to take it. The same PP is coming into my balance sheet. Right. Now listen carefully. But we are taking it as fair value because we will take it at business combination. We will take it at 1600 rupees because that is the fair value. Got it? Now listen, my dear, DTL also will come, my dear. It's not that DTL will not come. What is recognized by him, DTL also will come to my balance sheet for sure. Okay, na? Right? That is where generally students do not understand, and that also will come. Now, right? But sir, DTL 60 is for what? 60 is for difference between 1000 and 800. Correct. But company book value is how much? 1000. But 1000 to 1600 has gone up, na? Correct. 600 into 30%, 600 into, right, 6 3 is 180. Correct na? Yes, 180. E180 you are supposed to recognize now. Now you are supposed to recognize that will become 180 DTL further up. Down है तो DTA recognize करेंगे और reversal of DTL we are going to do it. Yeah, acquiry tax base book value that must have already has become DTA or DTL in the acquiry balance sheet. What is sitting in the what is DTL DTA which is sitting in the acquirees books that will automatically come here. Plus not only that correct na, e DTL 60 rupees is with respect to what, e difference of 200, correct, but I am not recording at 1000. If you record it at 1000 then you don't need to calculate DTL or DTA separately, but you are actually taking 1600 rupees excess number you are taking. Now 1000 minus 1600 or 600, on that 600 again you have to calculate DTA DTL. That should be recognized in the consolidated financial statements of acquirer. Okay, right. Now come to the sentence. Recognize DTA DTL exist on the date of acquisition. Yes, you have to recognize. Consider any carry forward losses, unabsorbed depreciation also. This is also. What is this, sir? My acquiry made losses, right? And acquiry did not recognize deferred tax asset in that regard. Why, sir? Because acquiry may not be having virtual certainty with respect to taxable future profits. It doesn't have taxable future profits virtual certainty. That's why they didn't recognize it. Yes, that is true. But me, I am the acquirer. I am making already good amount of profits. Okay. If I have absorbed the other company, means other company is going to be closed. It means liquidated. Perfect. Now when you are merging both the companies, what will happen? Income tax department will allow. What will it allow? Your carry forward means acquirees carry forward losses can be offset by the profits of acquirer. Okay, under that circumstance, now I have got virtual certainty with respect to future profits. Now we in the consolidated financial statements, acquirer can recognize deferred tax asset in that regard. Okay, that is the good point. Next, do not recognize deferred tax asset or deferred tax whatever it is on goodwill. Deferred tax, not asset or liability, you are not supposed to recognize it. Clear? Done. Right, with respect to goodwill, no deferred tax at initial recognition of goodwill. Yeah, again actually my dear, you will be having a lot of detailed discussion with respect to that in Ind AS 12. Right. Employee benefits are any gratuity liability or such kind of things, no, that we strictly follow Ind AS 19. No new things are there here. Okay, done. This is one more new good point which is asked in the examination. Indemnification of assets. What is asked? Indemnification of asset. Yeah, indemnification asset, not indemnification of. Okay, indemnification asset means, yeah, simple. Suppose there is a right in the balance sheet of acquiry. Okay, not in the balance sheet. Let me say there is a contingent liability. Somebody filed a case against our acquiry company. Okay, that guy filed for 100,000 rupees ko file kar diya. Yeah, we calculated fair value of it. We calculated as 600. These 600 rupees I have taken as a liability. Just now I taught here. Correct na? Right. Now the point is, we may be asking the other company, boss, you are telling as a contingent liability. Fair value is equal to 600. Tomorrow that guy claims, correct, I have to pay. No, because you are no more now, because you will take my consideration and you will leave the place. True. That's why other company acquiry company shareholders may give indemnification. Sir, don't worry. Right, we wrote 1000. If there is any problem up to 1000, up to 1000 rupees aa gaya to na, I will pay you money, my dear. We'll write an agreement and that guy will go. Suppose in case the contingent liability, the case is resolved, settled against us. That means I ended up paying 1200. Okay, yeah, I thought 600, but fate is bad, it became 1200. Now what will happen? 200 I have to pay from out of my pocket, and 1000 because they promised me already. Up to 1000 I can get it, na? Correct. Got it? Yes. So when I write contingent liability of let us say 600, yes, here you should write indemnification asset. Indemnification asset also 600. Sir, they gave 1000, na sir? Why are you writing 600? Arey boss, see today, as of today, I'm expecting 600 is the fair value. Correct. So if 600 is payable, when I say I will be able to collect 600 only from the other party. Correct. That is the point. Hope you understood. See, when I myself says my fair value is equal to 600, I am expecting 600 only will be payable. Yeah, they gave me guarantee that up to 1000. But when you say I have a liability of 1000, then you will say I have a right to receive from the other party 1000. Right? But you are showing as a liability. Correct. Now you are showing as a you are showing what is that? You are showing as a liability 600, then 600 only is recognized. Tomorrow you increase the 600, increase it to 700. Then he said indemnification also 100, increase it. But indemnification asset cannot go beyond 1000 because 1000 is the amount done. Okay, right. Indemnification asset, how should I measure it, sir? Arey, what is the measurement basis for contingent liability? Na? Same measurement basis you are supposed to use it for indemnification asset also. Got it? Right. It acquires if acquiree is indemnifying against any particular liability, correct, now outstanding on the date of acquisition, recognize the asset. Right. Measure it on the same basis of liability. Yes, you have to measure it on the same basis of liability. Okay. Next, reacquired assets. This is one more new concept. Okay, reacquired asset means I only sold some intangible assets, so copyright, so franchises, something I only sold it to. Sold before business combination, I sold it to my subsidiary now. Now what is happening? I sold them. Okay, super, sir. Now what is happening? It became correct. Now I am acquiring. No problem. That you recognize as intangible asset only. That's it. Okay, na? Right. Acquirer might have correct. Acquirer. This is some small errors are there. Acquirer might have bought the rights of acquire. Correct. Na? Acquiree might have bought the rights of acquirer before acquisition. Correct. We sold, they bought it. As part of acquisition, acquirer take back those. Yes, you can, that is identifiable intangible asset. As usual, normal at fair market value, recognize it. Even though you sold only, but situation has come, we are buying now, buy it and recognize it. Okay, sir, it is useless for me, then charge it. Once you recognize it, then you transfer it to P&L. Got my point? Like that. Measure it at fair market value. If it fair market value of it, considering the remaining life of the rights. Normal accounting, fair market value measurement, we will do it. Nothing new as such. Okay, next. Assets held for sale. Assets held for sale. Right. What are we supposed to do? Yeah, listen carefully. There is an exception. Here something is typing error, something missing. See, my dear, as per Ind AS 105. What did I say? As per Ind AS 105. What happens as per Ind AS 105? Normally, if any non-current assets are held for sale, it will be measured at book value or fair market value minus, correct, fair market value minus selling cost, whichever is lower. And if there is any difference comes, that will be transferred to P&L. Correct. Now the question, acquiree company, correct. Now the question, acquiree company has some assets which are held for sale. Correct. Now acquirer company is taking over the other company. Acquirer company is taking over it. True. Acquirer company is taking over it. Correct. Now generally acquirer company should be recognizing all assets and liabilities at fair market value. Am I right? Yes, it should be recognizing at fair market value. Now what will happen, it is generally, but with respect to those assets which were held for sale in the books of acquiree company, we will be measuring in Ind AS 1 in the business this is an exception to our fair market value rule. We'll measure it the same amount. Same amount means it will be measured at fair market value minus selling cost only. We will be measuring it, not anything else. Correct? Na? The other assets will be measured at fair value. Okay, and only those assets which are held for sale will be measured at fair market value minus selling costs. Hope you understood. Normally, I repeat once again, normally when acquirer is recognizing the assets and liabilities, of the acquiree, we record it for FMV. Right? I can say except which were held by the acquiree, at what? Held by the acquiree for sale. Right? It is held by acquiree for sale. Acquiree must have recorded already at FMV minus FMV. Correct? Na? Right? I mean, it may be book value or FMV minus selling cost by them. By whom? Acquiree. But I will be recording, for me there is no book value concept. I will be recording at fair market value minus selling cost, but not at book value. No. But not at fair market value. No. It will be at fair market value minus selling costs. That you need to keep in mind. Just give me 1 minute, I'll be back. Okay. Yeah, let us continue. So I mean the goods which the assets which were held for sale, other company must have noted at book value or fair market value minus selling cost, whichever is lower. But the acquirer is going to recognize it at fair market value minus selling cost. Normally we recognize it at FMV, but here a small exception, we cut selling costs. That's it. Okay, next. Yeah, here there is some big discussion with respect to SBP, share based payment. Yeah, listen carefully, right? Otherwise it may you may not be able to understand it. Right? If the acquirer replaces the share based payment awards, who has replaced? Acquirer. Right? Means what? Acquiree means that old company. Acquiree company has issued already some SBP to the employees of the company. Now acquirer comes and says, "Arey, ye old SBPs chhod do yaar. I will give you fresh SBP. Correct. Now you have to look at some conditions also. You are supposed to look at. Listen. Maybe old SBP plan will be, say, 4 years you have to work. Correct. But new, right, already 2 years they worked over. Now this new, correct, new, what is it? New SBP plan, what they say? From today you have to work for 3 years. That means actually as per the old SBP, 2 years if they work sufficient. But now what are they telling? Now what are they telling? No, you have to work one more extra year. Then I will give you more number of shares here. It is not that I'm going to give you less consideration or something. I'll give you better offer. But you just be there. Got it? Right. That is the reason. Now listen. Account them as a modification as per Ind AS 102. Yeah, a modification you studied. Correct? Na? I mean incremental SBP, so many things. Right. Such replacement is part of consideration. Yes, it is part of consideration. Right. It is if issued voluntarily, record it. Correct? Na? Suppose voluntary, it is not mandatory. My company has issued some extra SBP after, correct, it is voluntary, it is not as per the agreement mentioned, agreement between the acquirer and acquiree, if you say so. You got my point? Under that circumstance, my dear friend, you don't need to, it won't affect my goodwill, correct na? Right, one second. It is part of consideration means what, when you're writing journal entry for business combination, okay, if you're paying excess money, it in the, whatever the assets you have taken, assets account debit, to liability, to consideration, goodwill account debit, correct na? Here only, what is that, SBP reserve, this also this also will come here. The minute it comes SBP reserve, automatically goodwill number goes up, correct? Goodwill is the balancing figure, automatically it will go up. That means it will have impact on your goodwill because of this. Yeah, when I say it is part of consideration means you have to be careful on that. Okay, next, if you should voluntarily record after business combination as per Ind AS 102. Okay, record it after business combination. Yes, voluntarily I give. Yeah, correct. Now separately I will record journal. This is nothing to do with business combination. That time your goodwill or capital reserve will not be affected due to my voluntary SBP I am giving. Okay na? Right. Now fair value of the replaced SBP plan should be allocated between pre and post. Correct. The fair market value of the SBP plan will decide. Right. Obviously there is fair value of the option. Correct na? That will be decided between pre and post. Yeah. Right. Now listen carefully. What is pre, sir? Pre-combination portion is treated as purchase consideration. Yeah. Pre means before combination. This is part and parcel of your this one. E number post combination will be charged to P&L. Charged to P&L over the remaining life. Remaining life means remaining period, how long these guys are going to work with me in my example. 3 more years they are going to with you. Right. Over 3 years as an employee benefit expense, so SBP reserve, employee benefit expense, SBP reserve, like that will pass 3 years, 3 journal entries, and we'll close it like that. Okay, post combination portion is charged to P&L. How to calculate I will tell you, but just how to account I am telling first. Yeah, as usual over the remaining vesting period, which I told you just now. Right. Now look at the pre-combination service. What is it? How do you calculate? Yeah, pre-combination, what do you do? Fair value of SBP and date of acquisition based on the original term. Original was 4 years na. Today what is the value? I'll say today value is equal to 100, sir. Okay, fine. Into vesting period completed. How many years completed? 2, sir. Divided by greater of total vesting period. Total vesting period is how much? Total 5, sir. How means 2 already worked, sir. But as per the new SBP plan, I am supposed to work 3, sir. So total 2 plus 3 is equal to 5, sir. Or, okay, or new vesting period. Yeah, new vesting period is equal to 3. Whichever is correct, na? Whichever, what is the greater? Whichever is higher. Higher in the sense 5. Correct. So 100 into 2 by 5. This is going to become pre. This is going to become pre. Pre will be part and parcel of SBP reserve. Part and parcel of your journal entry for business combination. Automatically, correct, automatically will have impact on goodwill. That's it. Now any subsequent change to plan or for feature, that is nothing to do with business combination, charge to P&L. That's it. Next, this is applicable for equity settled and cash settled, everything. Okay, how does it matter? Here SBP reserve placement, what will come? Your SBP liability will come. That's all. Correct. Now you know, right? You are aware of Ind AS 1 or 2. SBP liability, SBP reserve placement, SBP liability will come. That's all. Name changes, not the thing. But again, if it is SBP liability, subsequent change in SBP liability should be charged to P&L. As usual, it is supposed to be remeasured at every year end, till the date of settlement. Correct na? That's it. Right. Non-replacement of awards. Kya bola? Non-replacement of awards. Okay. Means what is that? We are not exchanged. We are not giving new thing. Yeah, old things are there. If vested on DOA, yes, that will be leading to NCI. Correct? Na? Vested means what? We are supposed to give them shares. If you give them shares, right, I am holding 400 out of 1000. But if I issue shares to these guys, 1000 will become 1050. Then 1050 over and 1050 is there, correct? Na? 1050 is 1050. Suppose I had 600. 600 over 1000 I had. Now let me calculate. Add 600 over 1000 means 60%. Now 600 over 1050 it will happen. Correct? 57% is only my stake. Earlier 60 became 57. Yeah, it will have impact. NCI portion goes up automatically. This is only, just now I taught, other components of NCI. What is this? This is only other components of NCI. Got it? Next, unvested DOA. Sir, unvested, sir. Means I told them 4 years to work. They worked for 2 years, sir. Still 2 more years they are supposed to work, sir. Okay. Then in this number also, obviously, again, you will measure fair market value on the date of acquisition. That is going to be bifurcated between pre and post. That's it. As usual, same concept. A pre part will be part of business combination. Post will be charged to P&L as employee benefit or the remaining vesting period. That's it. Look at the same. Pre. Debit, correct now. Debit employee benefit expenses and credit SBPR on date of acquisition. That's it. Next, post. Charge to employee benefit expenses. Credit to SBPR over the remaining life. Got it? No, this is not pre's debit. None. Pre you are supposed to debit, goodwill will come. Okay, na? Yeah, this is some small error. It is going to be goodwill. Fine. It is going to be goodwill. Same concept, same measurement. Here it's going to be 2 by 4. It will come. That's it. Because here there is no new part is not there. Na? 2 by 4 will come. Right, calculations all will remain same, accounting also will remain same. Okay, some small typing issues are there, obviously. Okay, or maybe we are drafting while writing also, errors are possible. Right, intangible assets. Intangible asset. Right, intangible assets normal only. Ind AS 38 is a relevant standard. As part of business combination, kya bola? As part of business combination, yes, these are all identifiable intangible asset. Recognize it separately from goodwill. Correct. Because based on the separability, contractual, legal criteria, all that you are supposed to see. Right. Even though cannot be transferred to other. When suppose you have a legal right. What is that? You have a legal right. As per the legal right, you can't transfer it to other party. Still, it is an intangible. Still, it is an intangible. That should be okay, that should be considered. Next, but it should be satisfying the definition of intangible asset and contingent condition of asset. That is there. Both are. Suppose obviously if it satisfies intangible asset only, it will be recognized in my books as intangible. If it does not satisfy, obviously why will I take, my dear? Obviously I will not take. Okay, right. Next, with respect to leases. Leases matter again linked to acquirer, acquiree, and many things are there that you try doing on your own. Okay, right. Measurement period. There is one concept. Yeah, and next subsequent measurement concept is there. Then we'll go to what is that? CCBC concept. Yeah, we are left with approximately 16-17 minutes approximately maximum. We'll be able to close it. If time permits, I'll come back. Okay, measurement period. Yeah, measurement period in simple words, I'll explain it to you. The measurement period means you have to measure the fair market value of consideration given, fair market value of the net assets, identifiable net assets received on acquisition, correct, at fair market value on the date, correct, as on the date of acquisition, you have to measure it. But sometimes what happens, you may not be able to measure it immediately. What is that I said? You may not be able to measure it immediately. Why? Because right now what will happen, based on the provisional basis they will calculate it. Suppose subsequently after I measured provisional basis kuch kiya, within 1 year from the date of acquisition, I got to know. What you got to know? I did a mistake in calculation. Oh, you did mistake in calculation? Yes sir. Then within 1 year, correct na? If there is any error or wrong information, correct na? That is, Ind AS 10 events occurring after the balance sheet, yeah, which are like adjusting events. Do you remember? Situations or condition exist on the balance sheet date. Here exist on the date of acquisition. That's all we'll write. It is existing on the date of acquisition, and subsequently, correct. If it is existing on the date of acquisition, then you are supposed to do. Okay, if it is existing on the date of acquisition, right? Then subsequently, if you get information, that has to be adjusted with goodwill or capital reserve. But a period, maximum period is how much? 12 months from date of acquisition. Look at sentences. For calculation of goodwill or capital reserve, fair value assets are supposed to be measured. Correct. If fair market value amounts are based on the provisional numbers, provisional numbers, okay, and any change in the final amounts within 1 year from the date of acquisition, that should be correct. Now listen, if there is a change, sir, correct, that is not because of the situations which were existing on the date of acquisition, sir. These are all new situations came up subsequent to acquisition. Then that due to, if the fair market value of something is changing due to the change in the situations after DOA, will not be considered. Okay, right. That should be an error, such kind of thing which you have not, it may be error or omission which we forgot or which we wrongly considered. Then it will be adjusted with goodwill or capital reserve. That's all. Change in FMV should be based on the conditions exist on. That is what I am telling. But not subsequent changes. No. That change in value will be respective standard as per your accounting policy will be considered. Why what? Maybe PPE. You must have followed revaluation model. Correct. Subsequently, there is a change in value. That will be transferred to revaluation reserve. That's it. Like that. Okay. Next, after 12 months, if any change are identified, okay, that should be charged to P&L. If there is any change, that should be charged to P&L. Okay, yeah, with goodwill, capital reserve, and etc. Got it? Right. Now, listen. Subsequent measurement accounting. Okay, subsequent measurement means it is not with respect to 12 months concept. Today date of acquisition, which days are? Let us say on 30th/6/2021 acquired. Yeah, my balance sheet, my date of balance sheet. Next balance sheet date is 31st March 2022. What should I do on 31st March 22? That's it. Yeah, one by one we'll discuss. Right. First, with respect to contingent consideration. If you remember, I told you contingent consideration should be classified either as a financial liability or equity. Correct? Financial liability or equity. If it is a financial liability, it should be remeasured again and again. Every balance sheet date may remeasure karna. And if there is any gain or loss, that should be charged to P&L. Okay. If it is equity, no remeasurement. Right. Now, yeah. Now contingent consideration. Now, what is that? Yes. Here I told. Here, if it is right, let me go ahead with it. Yeah, situations and conditions existence on the date DOA changed. Yeah, if you say yes, sir, situations changed, sir. Then if it is less than 12 months, then adjust with the cap. This is what I told in the above measurement. Right? No, sir, situations and conditions are not changed. Now, like meeting the target, share price, something, etc. Accounting is based on the initial recognition. Initially, how is it contingent consideration recognized? Are initially recognized as a liability. Okay, then you are supposed to write payable in cash, other assets. You have to remeasure it on every balance sheet date, which I was telling. And that effect will be given it to the P&L. Okay, right. No, sir, it is equity, sir. Initially, suppose I told you, fixed. That means fixed number of shares. Yeah, well, how many are you supposed to give? Fixed number of shares for fixed amount of consideration. Okay, now fixed amount of consideration. We say like, right, 50 lakh rupees worth of shares, each share at the rate of 100. That means 50,000 shares. 50,000 shares are going to be given. If 50 number will not change, it will not vary due to any reason. That means it is equity. If it is equity, we should not remeasure it. Subsequently, we'll keep quiet. And basic rule, my dear, once you transfer any amount to equity, Nana, correct? Equity, no change, Guru. It cannot be happening. There won't be any change because of this. Okay, right. Next, reacquired assets. Yeah, you already got assets. I told you, no? I mean, in some few pages before, we sold some rights. They have our franchisee license, something which we recognized it based on the remaining life of the asset. Normal, there is nothing much actually. Okay, recognized already as an intangible asset, amortize over the remaining life. Correct? Now we recognized at fair market value considering the remaining life of the assets. Yeah, because it is identifiable, something like that I taught you. Correct? Yeah, if sold, any gain or loss to profit and loss. That's what I told you. No? There is nothing much in this. Sir, contingent liabilities are. Yeah, contingent liability. Right, what is that we told initially? What is happened? Contingent liability, even though it is contingent liability, which was presented, I mean, which was disclosed by whom? Disclosed by acquiree as in the notes of account. If it satisfies, there is a project, there is a what is that? Present obligation arising from the past event. Then we say recognized at fair market value, even though it does not satisfy other two conditions, and Ind AS 37 is not applicable here. Ind AS 103 overrides Ind AS 37. That is what I taught you. Correct, na? Right. Now, here initially you recognized already at FMV as a liability. Told. Subsequently, what are you supposed to do? You measure it at higher of, whichever is higher. What is that? The amount to be recognized as per Ind AS 37 is the provision if there is something. Initially recognized minus any amount transferred to P&L. Okay, yeah, why is transferred? Because I must have already paid, or I must have it. There may be, it's a liability, no, my dear. If there is an increase, I must have increased it by charging it to P&L. Whatever the reason, maybe charged to P&L, maybe reduced from the P&L. That is simply you say book value. I'll say. Obviously, whichever is higher, you are supposed to do it, and our difference automatically will be transferred to P&L. Why, sir? Increase in liability is obviously an expense. Correct? Now, what is the liability? What is the expenditure definition? Decrease in assets or increase in liability, ultimately decrease in equity. Yes, should be charged to P&L. This is also not major concept. Next, indemnification of asset. Correct? Yes. On every balance sheet date, measure the asset in the manner of liability. I told you this. Contingent liability, in which fashion, in which manner it was measured. Indemnification asset also should be measured in the same manner. Done. If any doubt on the collectability, I may not get. I wrote assets, sir, but I have a doubt, sir. These guys already parar, sir. Okay, good, correct. They gave paper to me, sir. The useless, sir, today. Then what can I do here? Charge it to P&L. That is, that kind of asset cannot be there in the balance sheet. Correct? It cannot sustain there. Transfer it to P&L. It's allowance for doubtful debts. Transfer it. It is receivable. Na? It is a financial asset as per Ind AS 109. Then allowance. Allowance means impairment. Impairment means Ind AS 109 ko chalna again. That's the point. De-recognize the asset only when it collects. Correct? Na? Sells it, lose the right to collect. Either if you sell it or if you collect it, or I lost the right. Why you lost, right? Why you lost means a case someone filed, no. Now we got in favor. We got the judgment in favor. When you got the judgment in favor, that means we are no more liable. When you are no more liable, the contingent liability which you have recognized already in the balance sheet, AB nikalna, correct? That also you are supposed to remove it. And indemnification asset, which is there in the balance sheet, that also should be removed, because we won the case. Then I lost the right to collect it from the other party. They will pay me when I lose it, not when I win it. Got it? That's all. Fine. Yep. Reverse acquisition. Reverse acquisition. Right. Reverse acquisition may consideration. Some small points are there. Then common control business combination. Actually, reverse acquisition I already taught you. Correct, na? Right. This small portion you can refer, because I am left with only 5 minutes. right? 5-6 minutes. If time permits, I'll come back. Nothing, obviously. I always welcome that. Common control business combination. Yeah. When do you say it's a common control business combination? See, very simple. Combination of entities which are controlled before and after by the same party. Means it is actually, my dear, it is a business reorganization. Yeah, there is a ultimate holding company. Okay, there is a holding company. E holding company has subsidiary 1, subsidiary 2, or subsidiary 3, correct? Right, something like that. Now what is happening? We will say, we'll enter into agreement. Subsidiary 3 is going to acquire subsidiary 1, subsidiary 2, correct? But for the time being, what is happening? What is happening? S1, S2 are controlled by H. Now we correct now. These two company shares are in the hands of the H. Now we'll enter into an agreement like H is selling it to subsidiary 3. Okay, right. One question. Earlier it was these two companies were controlled by whom? H. Now it is controlled by whom? H. How? Yeah, because H is holding the subsidiary 3. Correct. Through subsidiary 3 it is controlling it. So earlier also, now also, it is part and parcel of the group before and after this transaction. Before and after this transaction, it is part and parcel. Hello, understood? Right. So that is the reason, my dear friend, you are supposed to, correct. Now what are you supposed to do? It is business CCBC, we say. Right. What is the matter here? Right. Means control of the group is not changed. Yeah, earlier was controlling, now also is controlling. Then only what the standard says, there is an appendix. Appendix C to Ind AS 103 has been incorporated. Appendix C to Ind AS 103 has been installed, incorporated. Okay, that's why we say it is a Carvin. Kya bola? What is it? It is Carvin. What do I say? Carvin. Yeah, this is the only Carvin in the Ind AS. We say Carvins, carve-outs. Correct. Not ins are not many ins. Carvin is only one. Outs are there. 8, 9 are there. Okay. Right. Important points are. What is important point? Right. Transfer subsidiary. Right. Important. Transfer of subsidiaries within the group. Yes, obviously. Partially owned subsidiary is also controlled by part. Yeah, so no need to consider the NCI. Correct. Yes, earlier also NCI. Now, what is the percentage of NCI? It doesn't matter, man. NCI change, correct. NCI percentage change may be there. No, we don't need to bother. Why? Means we, the group, had control over it earlier. We, the group, has control even afterwards. That's the reason. Okay. An entity may be controlled by individuals. This is crucial. It may be controlled by individual or group of individuals, but still create CCBC only when they have a power to govern. And in the sense, suppose A, B, C, 3 parties are there. These 3 parties, these are all Mr. A, Mr. B, something like that. Yeah, this guy has got 40%, this guy has 30%, this guy has 30%. Okay, yeah, they have stake in A, B, C, one company. Okay, and the same 3 persons, E3 persons are controlling, like XYZ company. Yeah, right. They have control, common control, correct? Na? They are controlling as per the agreement. Now, if say ABC is acquiring XYZ company, something like that, if they plan it, that is also part of business combination. CCBC, even though it is controlled by not by the same company, see, it is by the individual. So there is no word of group. Group word cannot come into the picture. Got it? Right. So then what will come? Even though it is controlled by the individuals, then it's going to be part and parcel. Got it? Right. Accounting method. Yeah, CCBC means pooling of interest method you will follow. What is it you will follow? Pooling of interest. Done. Yeah, that is what. Pooling of interest means recognize all assets and liabilities. Yep, recognize all assets and liabilities of the other company at its book value. The matter is, my dear, this concept, I believe, I also agree to it. Why? Earlier I was controlling, now also I am controlling. Just a percentage stake and under whom I am, correct? That's all changing. then why should I bring it at fair value? Correct. Now what is the need? Because we were the controller. Correct. Now we were controlling earlier, now also we are controlling. There is no need to have fair market value. There is no need to have fair market value. Correct. Now that's why he says, right, you have to record it at carrying value, book value, unless there is a change in uniform accounting policy. To ensure the uniform accounting policy, if you are changing, change it, that's all. Other than that, no need. Okay, right. No new asset will be, no new asset, no new liability, no goodwill will be recognized. Yeah. Present financial statements as if, correct, now business combination took place at the beginning of the financial year. Done. Right. This is one point. Even though I mean to say beginning of the previous financial year. Sorry, not just financial, previous financial year. In the sense what, sir? Yeah. See, current financial year is equal to 2020-21. Yeah, when is this CCBC took place? CCBC took place on 30th 6, sir. Got it? You know, CCBC took place 30th, but actually this is current year. For this comparative year, do you give or not? Yes, and that is equal to 2019-20. Even though it took place on 30th 6, we'll assume that it happened on 1/4/2019. Retrospectively, correct? Now we'll assume that retrospectively we'll go back and previous year restatement, current year restatement karenge. That's a matter. Consideration can be equity, cash, anything is possible because you are exchanging, na, possible. But in accounting standard 14, in case of pooling method of interest, I mean that method may, we say no, consideration has to be only in equity shares to the equity shareholders. But here there is no such rule, anything. Next, securities will be issued at nominal value, face value, not at fair market value, not at fair market value. Okay. Next, for value of consideration, take fair market value of assets, but accounting carrying amount, that's okay. Identify the reserves, yes. Maintain the identity, not identify, identity, yes. Identity of the reserve should be preserved. Means what, sir? See, if the reserve was free reserve before this CCBC, now also it should be free reserve way. Earlier it was capital reserve, now also it should be capital reserve. Adjustment. Which one? Suppose paid up capital, correct, any difference between share capital transferred and consideration given, that should be adjusted with capital reserve. Capital reserve can be plus or minus. This is very clearly said by the standard, notification, appendix C. That's it, my dear. There is one small part of demerger accounting and all. That's okay. That is not something major and not that important for examination also. Okay, you can obviously have a look at it. Right, whatever I am teaching is all from my book, that is a quick revision fast track charts. Yeah, after reading the chapter, after completing all the things chapters, if you read from here, I have covered almost every important concept from this text. It will be covering everything, my dear. Nothing will be missed out. And if you read everything like this, you will be more confident, because you can't sit and solve all the sums, At least if you do like this revision, proper revision, if it is done, then you will be very confident. Okay, my dear. Right, thank you. Thank you. I'll see you in the next class. Okay.